what we're going to be going over here is private not-for-profit accounting, and we're going to be looking at the reclassification here of temporarily restricted assets. So when we're talking about not-for-profit accounting here, not-for-profit organizations, those organizations really depend heavily here on donor contributions, or donors from the outside make contributions to the organizations, either being funding or some source that they're going to donate, some resource they're going to donate to the organization. And what this organization has to do here, the not-for-profits, they have to keep track of that funding here. The donor's going to give them money, and then most often the donor will put some restrictions on how that money is spent. So what these not-for-profits are going to do, they're going to have different funds here. And what they have in these funds here, they're going to have to classify the fund assets, or the resources, the asset resources in those funds here. And they're going to really have three different classifications here. But they would have typical funds here like a current unrestricted, a current restricted, or they'd have some plant fund for land and buildings, and numerous other funds here. But for each of those funds here, they have to keep track of, like I mentioned here, the fund asset categories here. So what they would do here, and you have to determine what each fund would include here as far as those restrictions. But what they're going to have here in the different asset categories, they're going to have an unrestricted net assets here in the fund here. Then they're going to have some temporarily restricted net assets, and then permanently restricted net assets. What we're going to be looking at here is the case where we're going to have these temporarily restricted assets here, and they're going to be transferred into unrestricted net assets. And there's reasons why that is done for accounting purposes here. And that's really what we're going to be looking at here. These not-for-profits have to report these fund balance. By fund here, they have to report the balances in the on these restrictions, these fund asset categories, whatever restriction they are. So when we're talking about these temporarily restricted funds here, what that would mean here is this is where the donor here has put some temporary restriction on how those monies should be spent, or those resources that he contributed to the organization should be spent or distributed here. And what happens here with these temporary restrictions, they actually expire here. They would expire here either by a stipulated time has elapsed here, time has elapsed for spending those dollars, or the stipulated purpose has been fulfilled here. So, and then there's also the useful life of the asset would have ended here, and that's really through depreciation. So the cases here, we're going to be taking these temporarily restricted dollars here. That's where the donors set some stipulations on here on how those funds could be spent here, or resources. And once those funds are actually, or those resources are actually used or spent here, or used up, then they get transferred into the unrestricted net assets. And there's a reason why we do that, and that's really for matching operating expenses and so forth with the assets that were contributed. Okay, so let's go and let's look at what we're going to do here. So to transfer from this temporary restricted to the unrestricted net assets accounts, you're going to go through, you're going to have some accounts set it up here as net assets released from restrictions. And that's going to, really that account includes setting up a reclassification out here for the temporarily restricted asset when the stipulated purpose has been fulfilled or time has elapsed, and it's going to go into a reclassification in the unrestricted net asset. So we're going to transfer it out here from temporarily restricted net assets into the unrestricted net assets, and using these two account titles here, the Reclassification-Out and to the Reclassification-In. So this net assets released from restrictions here is really those two accounts here, and it's not just one account. These accounts here, this net assets released from restrictions, are in all the net assets or funds here. And what we're going to look at is this when and why we would make the transfer here from our temporary restricted net assets to the unrestricted net assets. And what we're talking about again is the restrictions. That would be donor restrictions and how we spend the money. Okay, so let's really go and let's look at just our basic, we're going to look at 3 cases here, but we're going to just get a basic understanding here of the entries that we'd have to make. So let's just say here for case 1, we receive some cash donations here, and the donor has put some temporary restrictions on how it should be spent. And then we receive it in 1 year here, and then comes along the following year here, or the next year comes along here, and we actually use those dollars up as what the donor specified. We used them up for the stipulated purpose that the donor specified. So these funds were initially classified here as temporarily restricted. So let's just go look at our accounts that we were dealing with here. So first off, we're going to have this, actually we would have 2 cash accounts. First we'd have our cash account for the restricted cash here, and then cash for the unrestricted amount. That unrestricted amount becomes, the cash becomes unrestricted once we make that classification from the temporary restricted to the unrestricted asset. Okay, so let's look at the case here. Okay, we have the cash account. We would have debited that here for $5,000 based on those donations and the restriction that the donator put. It would be a restricted cash account here, $5,000. Then the credit would have gone to revenue. Let's just say we recognize revenue, and this is temporarily restricted revenue. So that's the key here. Make sure you keep your titles straight here when you're talking about all these different accounts. And I'm just using a basic example here. So on our revenue account for temporarily restricted, we would have credited that here for $5,000. So we received the restricted cash here, debited for $5,000, and in our revenue account here, we credited temporarily restricted cash here for $5,000. Now comes along the next year here, and this is where we're going to actually release that cash here from the temporarily restricted account here to the unrestricted account. And there's a reason why we do that, and we'll get into that in the next example here. But we're going to do that with these accounts here, and I'm just showing these 2 accounts that we're going to look at here, the reclassification-out and the reclassification-in. They're just the 2 accounts that you would have in this net assets released from restrictions here. So what we would do here, before we can actually pay those, we're going to be paying out that $5,000 here in the next year. But before we do that, we will simultaneously, we're going to make those entries here. We have to release that cash. We've got to make the cash that was restricted, it has to become unrestricted here. And we do that through this reclassification account here. So for our transfer out, we would have the reclassification out here in those for the temporarily restricted dollars. We would have, let's just say, I'm just showing it as a debit here, we would have transferred it out here, so we would say debited the reclassification out for $5,000 dollars that we released here. Now we'll be able to pay those dollars, but we have to first bring them into the unrestricted net assets account, and this we do through the reclassification-in here for the unrestricted dollars. So this we would transfer in, we'd credit that here for $5,000 for the transfer in. So you see, when you spend these dollars here, you meet the stipulated purpose here, and you actually either recognize your revenue here, and then we're going to be looking at our expense here. We'll look at maybe we should go back and do that here first. So in our expense account, okay, we released the dollars here, transferred them out here, reclassified them out, debited it here, and brought them into the unrestricted dollars here, credited that here for $5,000. So what we would do, now we can go and we can pay the expense here. So in our cash account, it would become the unrestricted cash now. We would credit that here for $5,000. We had $5,000 sitting in the restricted amount. Now it was reclassified as unrestricted by making these entries here. The reclassification out from the temporary restricted account to the reclassification in here for the unrestricted amount. So that's where we got our cash unrestricted. So credit our cash here, unrestricted cash for $5,000. Then we can go and pay our expenses here. So then we would debit our expenses here for $5,000, the unrestricted, and that would be unrestricted cash here that we spent. And that was through by making our reclassification out here from the temporarily restricted to the reclassification here into the unrestricted deal. So here we paid it out, but we did that after we made our reclassification. Actually, this would be simultaneous entries. But the point is, when you're paying your expenses here out of some previously restricted dollars, this is, I'm saying they were temporarily restricted dollars, then you got to make these entries here for this reclass within the fund here, the reclassification out and the reclassification in. So what we've done here, not to confuse everything here, but just to understand the basic setup that's going on here. We received money here, just to go over it, we received money here as restricted funds. We recognize it as revenue here. In this case, it was temporarily restricted funds. And then when we actually paid it per the stipulated purposes here, then the cash became unrestricted. And then we recognize our expense here. We paid out our expenses unrestricted. But we did it by making this, we have to do this transformation here. We got to do this reclassification out here, or of our temporary funds. We have to move it out of the temporary restriction here and move it in here to the unrestricted funds here by using these two accounts here. Okay, so what we're talking about here, this net assets released from restriction accounts, those are really those two accounts here. They always zero out. They always have to zero out. You had a reduction here in your temporary restricted assets here of $5,000, and then you would have had an increase here in the reclassification in here of $5,000. They always have to balance out. There's really no impact on the financial statements bottom line here. What you have is an increase in one of your net assets, but a decrease in the other net asset. What you're really just keeping track of is these fund asset categories. Okay, so just remember that. You got to set up these accounts here. When you are actually spending funding here, for the stipulated purpose. So when you actually spend this funding here through some expense, just remember you have to make the reclassification out here from the temporarily restricted account to the reclassification in here to the unrestricted account. And that's for keeping our accounts and keeping our, we'll look at exactly why we're doing that here, a little better explanation. Okay, so let's go up and let's look at our next example here. Say, for example, some contributed goods here, inventory goods of $1,400 were used during the year here. So these goods were contributed. There was some stipulation on how these goods or these inventories, and we classify them as inventories, should be spent. And of the $1,400 here, this amount included $700 worth of donor restricted funds. So let's just say the total $1,400 here of the inventory that we're going to look at, only $700 here was donor restricted. Again, we're going to do the same thing here. We're going to have to do some reclassification out here of the temporary restricted funds here and the reclassification in here, or transfer in for the unrestricted funds here. So just looking at, this is the case here where we actually made recognized the expense, or we had the expense here coming out of inventories. In this case, we have recognized the expense, but the expense is recognized based on meeting those donor requirements. So in our inventories account, what we would have done for the total $1,400 here, we would have credited that here for the $1,400 inventories. We reduced our inventories by that amount for the amount used, and then in our supplies expense, this would have been in unrestricted. This is, their inventories were donor restricted here, but our supplies expense are going to be unrestricted because they're going to be released here from the temporary restricted asset account to the unrestricted asset account. So supplies expense, debit that here for $1,400. And then in this reclassification here, we're going to have to, of the amount that we actually had, of the donor restricted amount, we would transfer it out. So we release these funds here by debiting or reducing our reclassification out from the temporary restricted amount here for $700. That was the donor restricted amount of those funds, of that inventories or goods that we used. And then the reclassification into the unrestricted amount here, we credit that here for $700. So we transferred it in here to the unrestricted reclassification-in account here, and it was transferred out from the reclassification-out from the temporarily restricted accounts. So you see, again, we have to set up this, make this reclassification-out and reclassification-in through those accounts. And the case here is, again, they zero out, but the reclassification, the reason we did this reclassification is, and I'm not really going to, it's not evident here, but it matches our operating expenses here on our financial statement. We're not going to go into, I can't show it here, I'm not showing it here, but that's really the reason we're making this entry here. So these expenses here, they were spent based on the donor restrictions. And then when we do our financial reporting here, we have to match our dollars. Our actual dollars spent here, it's the unrestricted, they became unrestricted dollars here, and they're going to be matched with the unrestricted expenses here. So this is it here. Okay, so the reason here for making that reclassification, and I'll just go through the definition here. This is where we're going to be releasing donor-imposed restrictions through this reclassification here, which simultaneously decreases the temporarily restricted net assets and increases the unrestricted net assets. And we do that in order to match expenses. Now, the expenses that were supported here by that donor restrictions here, that'd be like the operating expenses, depreciation, and so on, fourth here, which decreases really the net assets. So we made that transfer here through this reasoning here for the reclassification, and that's just really the general setup that you would use here when you're accounting for those nonprofits. So I'm not showing exactly where you're getting and matching these funds here, but just remember you're doing it for matching those donations or those expenditures that were those donations here with that stipulated purposes and how they'd be used, and they're really going for operations here, operating expenses here through the financial statements. Okay, so that's our basic reason for making this reclassification. And now let's go down and just look at the third case here. Now this is, we're going to, again, we talked about the case here where donor restrictions here, say the donor contributed some fixed asset here, or we purchased some fixed asset here with donor restricted dollars here. So this is the case where we're going to be, again, matching our expenses here on this fixed assets with the donor restrictions. So what we're going to actually be doing is using up the fixed assets that were purchased here with donated restricted dollars. So again, this just represents the depreciation expense. So you can have other expenses, but when you're doing these, when you're taking a net asset here, donor restricted net assets, either it was donated by the donor itself or purchased with some donor restricted funds here, you have to again use the reclassification for those expenses. So just looking at our example here, we take, say for example, we have accumulated depreciation here on that donated asset or the funds purchased. We purchased some donated asset here with some funds here, donated funds. So in our accumulated depreciation, we'd credit that here for $5,000. And then going over to our, again, our depreciation expense here for the donated asset, this is where we're going to be using that fund matching. We would have debited that here for $5,000, and that would be the unrestricted amount here of funds. So again, we have to go through this reclassification here for that depreciation expense. So a reclassification out here for the in our temporary restricted funds here, we would debit that here for $5,000. So we're releasing monies here that are actually being spent here, recognized as depreciation expense. So we transfer it out, we debit, reduce our reclassification out here, temporary restriction, just said debited here for $5,000, and then the credit goes to the reclassification in here into the unrestricted funds for credit that here for $5,000. So that's the transfer in the reclassification in, transfer out here for the reclassification out. Now you can see there was no dollars actually exchanged here. It was only the wearing out of this asset or the using up of this asset here that was donated here or purchased with donated funds or whatever, but there was restrictions here on that asset and how those monies can be spent. It was spent on this asset here. So we're using up the asset here, recognizing an expense, but we're still having to release those dollars here for that depreciation expense through our reclassification out from the temporary restricted assets here to the reclassification into the unrestricted assets. So the depreciation expense was a fixed asset here, again purchased with some donated or restricted dollars here, for example. Okay, so again, we zeroed out here we have a zero out here in the in this reclassification from the reclassification out to the reclassification in. So it increased our net assets here in the unrestricted account and reduced our net assets here in the temporarily restricted account. So we have a zero out here, but the reclassification here was done to match our operating expenses here on the financial statement, because those donated dollars here were actually donated here, and they have to be, in this case, as recognized here as operating expenses as this asset depreciates. Okay, so that's basically a basic understanding here when we're talking about this reclassification here of temporarily restricted dollars. So just remember here, whenever you're recognizing some expense here based on some donated restricted assets or for whatever purpose the donor specifies on it, when you're recognizing some expense here, and you have to, in order to do that, you have to do this reclassification here from your reclassify your temporarily restricted assets here, reclassify them out, reduce them here in that fund asset account here, and then you would increase your reclassification in, transfer it in here to the unrestricted assets. And that, again, is done here for reporting purposes here. So you can match your operating expenses here with your donated, what your donated fund, or what you had in for your donations. Okay, so just a basic understanding of what's going on. Okay, so that'll end our discussion.